Testing 1 1, testing 1 1.
Oh, did you see it? Yeah.
Good morning, everyone, and welcome to the Joint Board of Managers Finance and Planning meeting this morning. Do I have a quorum now with Amanda? Okay, all right. We now have a quorum of the board and finance, so we will proceed as with our agenda. Leanne, you want to come forward and with our prayer?
Thank you. Good morning, everyone. When I was asked to come and pray for this joint finance and planning and board of managers meeting, I thought this is so appropriate because when I was in business school, I did my most praying during finance class. So with that, let us pray. Loving God, we gather together at this time of new beginnings. So much is happening. And at this time, we just ask that you inform our vision, that you ignite our energy, and that you inspire our collective hope. We have so much to do and so many people who are depending on us, our community, our team members, and most of all, our patients. The work that we're doing in this moment will change lives for people we have not even met, have not even been born. So let us never lose sight of the magnitude of our call. Let each person in this room and outside these walls be reminded of the good that only they can do. Thank you so much, God, for the privilege of serving your people in this way. It's in your holy name that we pray. Amen.
Amen. Let's do our pledge. I pledge allegiance to the flag
Of the United States of America and to the republic for which it stands, one nation, under God, indivisible.
Okay. All right, okay. Next, we have the approval of the Joint Finance and Planning Committee. Are there any corrections to the minutes? There being no corrections, I'll entertain a motion for approval. Okay, it's motion by DT, second by Steve. All those in favor of approving the minutes signify by saying aye. Those disapproved by nay. Motion passes unanimously. Okay, skipped an item. We do not have any citizen wishing to address the board, okay? And we approve the minutes. And then next we have the discussion and consideration of the resolution. And who is presenting that? Is that you? Finance, okay.
I have our bond counsel joining us at the table. This is, the first couple of slides are going to be a quick review from last week. And, you know, this is a big step towards our master facility planning. At the end of the presentation today, I'm going to be asking for your recommendation that we move forward to gain an order from Tarrant County so we can actually begin this issue in mid-February as it's planned today. Last week, we introduced to you all the players that are here. We have the underwriting syndicate, that has not changed. And then our consulting team, we have Chris Janning here today with Hilltop, and again, the co-bond counsels sitting here. We have selected the disclosure counsel, West and Associates. So, Chris, do you want to go ahead and, sorry, Chris was caught in some traffic and he's here, so that's good.
It's been a wonderful morning. Good morning. Again, just to restate what we had told the board at the last meeting, we've officially kicked off the final stage of putting together the formal offering. What's in front of you today is a resolution asking the county commissioners actually issue the debt on the district's behalf. It's just one of those quirks of Texas state law. And that's what the action item is going to be today. After this, what happens is we're planning on, we're asking the county to put it on their agenda for action and to pass the formal bond order. That is the legal document that issues the debt. Inside that document also, you'll see it gives you the right, or it gives your CEO and your CFO the right to finalize the final terms of those bonds when we actually go to market. When I say terms, set the interest rate, set what the maturity and the principal payout schedule is, and then more, as importantly, set the call provisions, because we do expect that right now, even in the market, it's a 10-year par call is pretty standard. As your advisors, Hilltop and Estrada, will push the underwriters. If we see an opportunity to get more beneficial call provisions, we'll certainly try to get you that. We also, as importantly, we need to go to the rating agencies and get the ratings. And until we know those ratings, we don't know what the formal, independent third-party opinion credit quality will be. That'll affect the interest rates. The other thing that the ratings may affect is, believe it or not, there's still one bond insurer out there that can, give a guarantee behind the tax pledge, if you will. And we have seen a handful of instances in the last 2 years with Texas hospital districts, GO bonds, where the insurance company gives a premium that actually is beneficial to the public. So, if that's one of those terms, again, that in the delegation, your management will tell them if that's beneficial. We'll show them the math, why, if we need to use that. Again, the nice thing is these are GO bonds, and beyond the tax pledge, there are no bond covenants, so the insurer can't add bond covenants. It would just be a function of getting the public the best deal. We plan on locking the rates and being in the market, finalizing those terms February 16th. And then the district, most importantly, will have its money for its construction March 16th. We wanted to show you, because, as I mentioned, your resolution asked the county to delegate the authority to your management to finalize these terms. So this slide shows you the sources and uses, as well as what the resulting debt service schedule would be. Again, these are our estimates. These are what we believe to be market rates as of this week. Plus, we still have a 0.5% cushion in those rates. One thing that we call to your attention is, we are generating $450 million for the construction account. We're paying all of our associated cost of issuance, and we're paying the underwriters. You'll notice that it's just a vagary of bond math, but we do believe that these bonds will sell at a premium. So and by law, it's still, you're using $450 million of your voted authorization. We think it'll take about $427 million. The rest will be a premium that the initial investor will pay to you, because, again, that may or may not manifest itself if it goes, to par bonds or something. Again, we'll be talking to your executive management on the data pricing.
Just as a reminder, what projects these bonds will cover. This slide is all of our bond projects in this phase of the total program, which is $1.511 billion over the next 8 years. At the top, we have the Psychiatric Emergency Center for about $80 million. The Medical Home Southwest, $37 million. The Magnolia Parking Garage for $63 million. And the Pavilion North expansion, which is the connector piece that will expand the ED and create that connectivity for the new towers later. We have a central utility plant for $200 million. and that is kind of the round number of 450. We are still working through and solidifying some of these numbers, but that is where the estimates stand today. The bottom number will not be changing. So also funded by cash, an alternative source will be temporary parking. That's a very short-lived life. That's $17 million that will be coming out of operations. And the medical office building as we work through several options there for about $168 million. In the second tranche of debt, we will be funding a portion of those new inpatient towers and the West Campus demolition as well. So if using the assumption of the 450, we will be issuing $350 million at a later date to get us to that $800 million approval. Are there any questions so far on these projects or the process that we're going to be going through to issue the debt?
When you said the bottom number, you mean the total program cost?
The total program is going to stay at $1.511 billion. Yes. So there is some shifting in between some of these numbers as we move from concept through design development and construction development.
So based on that time frame, and this cost is the projected escalation of building costs?
Yes, there is.
I know is this the order, the ranking order, what we will do?
It's fairly much in a timeline. You know, we broke ground on the PEC last month. We've just purchased the Southwest Medical Home land. That groundbreaking will occur in a couple of weeks. And then we have RFPs out currently on the parking garage, the north expansion, and the utility plant in various stages. The temporary parking is occurring probably earlier along with the PEC and the Medical Home Southwest, and the MOB is also under evaluation and RFP.
Okay. I've never agreed with that order, so that's what I was asking.
It's really more about staging and creating green space, taking up green space, and moving these projects around so that at the end of the project, we can get the new patient towers up.
That's what I want.
The total program cost, though, could change. It could go up, but the issuance of debt is still at $800 million.
That is
We
correct.
find another place to get the extra money. We're going to be doing that anyway, but
Right.
it's a definitive statement saying this number won't change, when in fact it probably will go up.
So what can happen is that the development of the program can be scaled back a bit. We might shell a floor versus build it out. So when I say the total program, right now when you look at available cash and the bonds, we are trying to keep in that $1.5 million. And as we work through these projects in design development, that is where we'll start to refine these numbers.
One more question.
Yes, sir.
And we may not be able to answer this, but this is kind of our ranking order of how we going. Is that sunken cement in reference to the board's ranking order and commissioner's court?
Your question is kind of how did we come to this?
No.
Okay.
No, I know We agreed. But I'm saying, is it such that you got a new court coming on? Will they then, can they come back and change our order of priorities?
So, Reverend, the order was through the bond planning steering committee was put in place so that the projects fell in like not just a chronological order, but an order that made sense. You can't build the new hospital without the utility plant, et cetera. I suppose that anytime the new court could try to change directions, but speaking as a board member and also a member of the steering committee, I would tell the commissioners court then they need to figure out a way to help us pay for it because it will no doubtly cost more money.
I mean, that's what I was asking. I just didn't want them to come and try to flip where.
Yeah, I think that with as much cussing and discussing that has gone on in the steering committee over how this thing should go and we want the medical homes first or we need the towers first or whatever else, that this is the most logical and economical way to build the future at JPS.
Yes, sir.
In the 1.5 billion here, is there projected already some overages and some buffers within that? And so would there be opportunities to save a little money here and there as we go? And what is the, likelihood that they were alluding to that, we may have to come back in 4 or 5, 6 years and say, well, we still need another 10% of this?
So that's two separate questions. I'm going to take one at a time. There is not only, as someone mentioned earlier, escalation of costs. As you know, construction costs are going up very quickly. So these numbers do include an inflator. And then each project also has a contingency built within it for things that you were talking about. The second part to your question is how do, if that contingency and escalation is not enough, how do we deal with that? And I'll speak for myself. My assumption currently is that the affordability is at $1.5 billion. As we need to move dollars between projects, there's opportunity within each one of those as we start to create design to have savings, even further savings within that project, but still allow for the future growth. And then when we can have that conversation and we can afford it after we build up some additional operating cash, that very well could be a possibility. All right, you're welcome.
Are there any other questions of Sharon? Okay.
So I've summarized, and Chris hit on all of these just a minute ago, what the resolution that you're approving is, and you do have a hard copy in front of you along with a copy of what will be presented at Commissioner's Court in December. So it does limit the aggregate principal not to exceed $450 million based on our project estimates today. The true interest cost would not exceed 6.25%. That does allow a lot of cushion in there, but there is a not to exceed amount in there. Final maturity is at 30 years or less, and then you are authorizing Dr. Duncan or myself to complete the issuance of the bonds in February.
There been any preliminary discussions with our friends downtown that they know this is coming?
They do understand that that's on the agenda. Dr. Duncan, Chris, and I will be meeting individually with the commissioners for a short call just to make sure that we have their individual questions answered, and if it'll also help me develop my presentation to the court
Great.
in December.
Thank you.
You're welcome.
Did I remember hearing last week that we were hoping to do some of these on a 20-year maturity, but we were authorized up to 30?
I don't remember that specific comment being made, but we will likely be more on the 30-year unless there is a financial reason that our advisors would want to shorten that time period.
Okay.
Any other questions? Beg pardon?
I'll be in my 90s by the time we pay off this one.
All right, then. Then I will entertain a motion for the resolution approving and requesting that the Tarrant County Commissioners Court adopt an order authorizing the issue of the limited tax bonds. All right. All right, there's been motion by Ralph, second by DT. All those in favor signify by saying aye. All those opposed by nay. Motion passes unanimously.
Thank you.
Okay, thank you. Well, that's over with. Okay, next on the agenda is Bill. You ready? Okay. Request for the approval of the sale and lease back of Tarrant County Public Health and the Health Center for Women's Properties.
Good morning, everyone. Madam Chair. This item is also listed under the closed session as it relates to real estate. And so we have it here on the agenda because it will require action. But I would, if it's okay with you, Madam Chairman, like to go to closed and go through the specifics and then come back out.
Okay, all right.
Thank you.
Okay, no problem. And then we will have the year-end investment report. Sharon, you want to come up and introduce and start it on that?
So per policy every year, our investment counselor, Hilltop, will come and present to you how our investments did over the last 12 months. Greg Warner has been servicing JPS now for about 8 years, as best we could remember before the meeting. But he's been with Hilltop. Before that, it was First Southwest, and he's been there for a minute. So you can introduce yourself and kick off the presentation.
Thank you. Would you pass the clicker,
you bet.
please? Yeah, I'm almost a little shy to admit I've now been with Hilltop and its predecessor, First Southwest, for 24 years. So doing this for a little while. I would, if you allow me just a moment, I'd like to introduce one of my colleagues. Alexis Correa has joined me today. Alexis is a new investment analyst with us, and he's doing a lot of work helping us through these presentations. So thank you. So I've been asked to keep these comments relatively quick. I'm going to go through this in what I call lightning round style. So I will speed through it pretty quickly. You have all these reports and so forth in your packets for your review. And of course, I'm happy to answer any questions that you may have along the way. And, you know, one of the first things I do when I prepare for these kinds of presentations is I like to review my notes from the prior year. And it was interesting this time around because, you know, from this perch a year ago, I said that going forward into 2022, the biggest concern and the one that was going to garner the most attention this year was inflation. And that turns out is probably the most accurate prediction I've ever made in my entire life. Clearly, that has been the big story this year. You know, a year ago, the view was that inflation would moderate, that it was transitory, it was a temporary phenomenon. And that didn't turn out to be the case. Instead, inflation has soared higher. It's fueled on by lingering supply chain problems and Russia's invasion of Ukraine, among other issues. So, you know, that's kind of the backdrop. I'm going to cover that in a little bit more detail in a moment, but before I do, I'd like to talk about the investment portfolio itself. But we just have to kind of lay that groundwork. We've seen a tremendous increase in interest rates as a result of the inflation, and that's having a dramatic impact on the portfolio, and will continue to into 2023. As of 9/30 of 2022, the value of the portfolio stood at $1.23 billion. It's a pretty sizable increase. It's up, again, it was $1.07 billion at this time a year ago. The bulk of that increase was in the operating fund, which grew by $137 million. We also saw a $21 million increase in the future fund. The other funds are relatively small and had relatively minor changes. The operating fund at this point makes up about 80% of the portfolio. And that's important because traditionally the operating funds must remain fairly short in their nature in terms of their investment maturities, and they have to remain very liquid to meet your ongoing operating expenses. And further, the current investment policy limits the final maturity of those investments to 2 years. Now, that's a fairly short investment horizon, and so it makes the portfolio susceptible to short-term changes in interest rates. Now, when interest rates are rising, that can be quite a benefit, and we certainly have seen that this year. In fact, this year, the yield on the portfolio went from 0.22 at 9/30 of 21 to 1.70 at 9/30 of 22. So that's an increase of almost 150 basis points in the portfolio's yield. That, of course, leads to a big increase in investment income. Last year, 2021, the portfolio earned $3.6 million. In 2022, it more than doubled to $7.7 million. I do expect it will be significantly higher than that in 2023 as some of the higher yields begin to make their way into the portfolio. So if you just do a little simple math, a 3% yield on $1 billion portfolio would generate $30 million in annual income. And we expect that the portfolio will exceed 3% in yield during 2023. So again, from $7.7 billion this year, we're expecting north of $25 million, or excuse me, $7.7 million this year. We're expecting north of $25 million in investment income next year, and it may even exceed that depending on where interest rates head. On slide 3 here, yes, sir.
Usually, the book value and market value wouldn't be that much different, but in terms of emergency liquidity,
you're correct.
Are we looking at book or are we looking at market value?
I generally am referring to book value because it's a more stable indicator. And since your portfolio, we hold all of your investments to maturity, they will mature at full value or face value. What's happened this year, of course, as interest rates rise, the value of fixed income investments falls. Right. There's an inverse relationship between price and yield or interest rates. So the very quick increase in interest rates has left the value of the portfolio declining. Now, again, we are going to hold these investments to maturity. They're very short-term in nature, so we will recover the full value when they mature. But it has, the interim has impacted the market value of the portfolio, and that's why you're seeing that big disparity.
So if we look at the value, the market value, if we have to sell it today.
If you were forced to sell it today, you would realize the market value. That's correct.
Does it take into account the penalty and all early withdrawal and all that stuff?
I'm sorry, does it take into account the what?
When we look at the market value, does it incorporate does the formula incorporate the penalty and all that stuff for early withdrawal, or it's just a snapshot of that market at that point?
It's a snapshot of the market at that point in time.
So it could be lower.
It could be lower, it could be higher. So if interest rates continue to rise rapidly, the market value of the portfolio will continue to decline. And I'll talk a little bit more about that. In fact, this next slide, we've got some additional detail that can give us some insight into that. So we'll look at some of the portfolio characteristics. I would note that this particular slide comes from our new investment portfolio reporting system. We don't have a full year of history in that system yet, so the prior period comparison here is just to the prior quarter. It's not to the prior year. When we come next year, we'll have a full year of history to share here. But just bear in mind, this is not a full year report here. It's just the most recent quarter. And I'm focusing now on the box on the far right, portfolio characteristics. The portfolio's average maturity was 0.67 years. That's 246 days. That's up about 55 days from a year ago when we were much shorter at only 191 days. We've begun to extend the maturities in the portfolio as policy will allow, because we're trying to take advantage of some of these higher interest rates that are available to us now. Looking at the pie chart at the bottom left, the allocation to U.S. governments and U.S. treasuries is now at 38%. That's a big increase. A year ago, it was only 9%. We also hold 32% in government agency obligations. Again, that's a big increase. It was only 7% this time of year ago. So the flip side of that, of course, if those items increased that much, something had to decline, and the decline came in certificates of deposit, CDs, which a year ago made up 47% of the portfolio. That's been trimmed to just 10% now. That's about a $375 million swing, and as you can probably guess, a year ago, interest rates were absurdly low, and banks were offering CDs at interest rates that were well above treasuries and agencies. And with interest rates rising so sharply this year, that has flipped. And so we're now able to buy investment securities at yields that are quite a bit higher than what the banks are offering in terms of CDs. And so we've reallocated the portfolio away from those CDs and into those government and agency securities. This next slide, slide 4, is kind of busy, but if you'll focus on the maturity distribution graph at the top left, this is really important because it tells us that about 40% of the portfolio is going to mature within the next 6 months. So Dr. Nguyen, to your point about the early withdrawal, this is still a relatively short portfolio. Essentially, 40% of it is going to mature in the next 6 months. And that's important because those maturities will then be reinvested at current yields. So some of the low-yielding securities that are on the books today that are leading to some of the declines in market value are going to be replaced by much higher-yielding securities over the course of the next 6 months. And then there's another 21% of the portfolio that matures in 6 to 9 months. So within the next 9 months, over 60% of the portfolio will mature and be reinvested at new yields.
Short maturities because of the operating.
Yes, sir. Yes, sir, and it was a strategy decision. Over the course of the end of last year and the first half of this year, we were deliberately keeping maturities very short because we were anticipating yields were going to rise. Now, we didn't expect them to rise as much or as quickly as they have, but staying relatively short has allowed us to have the funds available to reinvest and to take advantage of these higher yields. Now that we're there, we're starting to extend those maturities a little bit. So we're pushing that weighted average maturity out slightly. But again, we're somewhat limited by the policy, which is a 2-year final limitation in the operating funds.
Thank you.
And you can see that here. This is the benchmark comparison. So the red line is the weighted average yield of the hospital's portfolio. And of course, it was very stable there for a couple of years, and interest rates began to rise sharply this year. And the portfolio yield is climbing, but as interest rates have risen so fast, we're struggling to keep up with some of the shorter benchmarks. Now, again, this is important that we have so much of the portfolio maturing in the next few months because we'll be reinvesting at progressively higher yields. And so we'll see this yield line jump pretty dramatically over the course of the next few months. And just to put a little bit of emphasis on that, in the last quarter, we had $363 million of maturities. The average yield on those maturities was 0.37%. We made $262 million of purchases. The average yield on those purchases was 3.6%. So we've gone from earning 37 basis points to earning 360 basis points. In more recent purchases so far this quarter, we're seeing average yields very close to 5%. So again, it's ramping up very quickly. Those are pretty much all the comments I had on the investment portfolio itself. I'm going to jump in now and talk a little bit about the market and what's going on in the market. And I'll go through these pretty quickly. Feel free to interrupt me along the way if you've got questions. Major themes this year, I mentioned inflation, of course, that was one. We've also had a very strong job market, and then the flip side of that is, of course, dramatically higher interest rates as the Federal Reserve has been acting aggressively to try to get inflation under control. I thought this was really interesting. This is actually the survey of economists taken by Bloomberg News 1 year ago. And, just to kind of show you how people just didn't expect what we saw, the top box there, the headline CPI forecast, I've highlighted it over there on the right. The general expectation of investors and economists was that inflation would decline throughout this year. The expectation was we'd end the year at an inflation rate around 2.5%. We're just below 8%, so we're dramatically different than where the forecasts were. The expectation was the Fed would raise rates perhaps 25, maybe 50 basis points this year. Instead, we've already raised rates 400 basis points, and we expect another half-point increase in December. And then in terms of yields, the thought was that the 2-year Treasury would end the year just below 1%. Today, we're right around 4.5%. So much, much different than what the expectations were when the year began. This chart here shows the Consumer Price Index. You can see in the second half of last year, the first half of this year, the Consumer Price Index was rising fairly dramatically. That's the year-over-year change on the left-hand side. The blue bars is the headline, takes all items into account. The red bars is a little bit more important because that's what they call the core rate, which excludes food and energy. This is very closely followed. And you can see in the first half of this year, up through about June, the core CPI was actually on a downward trend, and that reversed in June and started rising through September. Now, the October data, which we just got last week, it's not on this chart, we did see a little bit of a decline that brought markets some relief. But obviously, when the Fed is hoping for stable inflation somewhere around 2%, and instead we're 6.5% to 7%, depending on your measure, we're well above where that expectation is. This next chart gives some detail to the components that break down the Consumer Price Index. And you can really see the impact of the pandemic here. If you look there around March of 2020, those gray bars that dip into negative territory, that's the energy component. So we saw downward pressure on the indices as a result of the lockdowns and the beginning of the pandemic. And then in March of 2021, as we begin to reopen, you see everything begins to expand. We see big increases in energy. We see big increases in the price of goods. That's partially a supply chain issue, as there's not enough goods to meet all the demand. More importantly now, though, the last year, you see the light blue bars at the bottom, which is the services component. So this captures things like housing, leisure, travel, and we're seeing dramatic increases in the services component. And obviously, if that part makes up 4% of inflation, it's going to be hard to get to a 2% inflation rate when you stack everything else on top. This is an index of shelter costs, so this takes into account the cost of housing. You can see a dramatic increase in housing costs. Housing costs tend to lag, and as they start to go up, they tend to run for a while. So this is something the Fed is really hoping to get under control. We'll follow this closely in 2023 to see if we have some impacts there. These are the employment indicators. So on the left is the change in non-farm payrolls. This is job growth. And you can see there's a declining trend in job growth. And that's to be expected when the Fed is tightening as aggressively as they are. But we're still growing jobs at about an average pace of 280,000 per month. The Fed's going to want to see this below 100,000 per month. So we've got some work to do here. The unemployment rate at 3.7% is just barely above a 5-decade low. And so again, the Fed really needs to see employment move higher in order to get inflation under control. This left-hand chart shows average hourly earnings. The blue line is the year-over-year percent change. And over on the left side through 2016, 17, 18, you can see that's relatively stable at roughly 2 to 3%. We get a bunch of volatility through the pandemic, ups and downs. But more recently, we've been running at a pace around 5 and 5.5% in year-over-year growth in average hourly earnings. And obviously, that leads to inflation. Now, you can see it's starting to come down, but we're still well north of a level that's going to be comforting. And then job openings and labor turnover, this measures the number of job openings. It peaked at close to 12 million job openings. There's only about 6 million officially unemployed people. So if you have 10 or 11 million job openings and only 6 million people looking for work, you're going to have some wage pressures, and that's what we in the Fed have been seeing. And I'm not going to bore you with the breakdown of gross domestic product. This is economic growth scorecard. Suffice it to say that after weak growth in the first and second quarter, we've seen a rebound in the third quarter. And it looks like the fourth quarter is going to have some fairly strong growth as well. And so that just indicates that the Fed still has more work to do if they hope to slow economic growth and slow inflation. This is the Fed's primary tool, the overnight Fed funds target rate. You can see a dramatic increase. We went from essentially 0 to 3.75, 4%. We'll end this year at 4.5% on this. So the Fed has raised rates aggressively to try to combat inflation. That, of course, has a big impact on overall interest rates. This is the yield curve. The top is the green line is current. The yellow line at the bottom is where we were a year ago. And you can see that the biggest increases have been in the short end of the curve, sort of that 3-month through 2-year area. And of course, that's right where we invest most of our securities. So that's one of the reasons why we've seen our market values decline, but it's also why we're investing at much higher yields today, and it's why we'll have much better investment income into next year. That, of course, has a big impact on mortgage rates, which have soared to over 7%, and you can guess what that does to housing as home sales are declining. You know, folks have a difficult time affording new homes and moving to bigger homes when prices have gone up by 40% the last few years and mortgages are suddenly 7%. The cost of an average mortgage now is 60% higher than it was a year ago. This is the 2-year Treasury yield. This is a proxy for investments that we are looking at. This is an area of the curve where we are frequent investors, and after starting the year around 50 basis points, we're now around 4.5%. So big, big increases. And then just in closing, you know, the economy has been very resilient and is still growing at a fairly rapid clip, despite some very aggressive tightening of monetary policy by the Fed. We still have, you know, inflation running at excessive levels. It has come down recently, but it's nowhere near the 2% target that the Fed considers stable pricing. And so we think the Fed still has some work to do and will continue to raise interest rates until they see inflation coming back down. And it's pretty likely that that's going to push the economy into recession sometime in the next year, probably around the second half of next year. So the big question is, you know, can the Fed orchestrate a slowdown in inflation without tipping the economy into a major recession? And we do expect at least a minor recession, but the big question will be whether it becomes more severe or not. And with that happy ending, I'll close my remarks and happy to entertain any questions if you have any. I'm sorry, couldn't hear you.
We have expected, and if you map that against the CPI, are we above or below?
You're below the CPI. In fact, everybody and everything is below the CPI. So even a 30-year Treasury yield, which is below 4%, is less than the current pace of inflation. So the expectation is that this inflation will give way. There's no one who expects that inflation will continue running at 6 or 7 or 8%. We do expect inflation is going to come down. It's a question of how quickly it comes down and where does it settle out. You know, do we go back to an environment where we're hoping to get to 2%, or do we get back to an environment where perhaps we're looking at 3.5% annual rates of inflation?
Do you have any projection what CPI will be at the end of the year for us?
Boy, that's a loaded question. You know, I'm hopeful that next year that the Fed will be successful and get inflation somewhere in the 2 to 3% range. I think it's likely that they will. I do think, however, that it's going to require that they push the economy into recession to do that. So there's going to be some downside to that.
All right. Any other questions? Thank you.
Thank you.
very, very much. Okay. Okay. Trent was not able to be with us today, but I think the general bond update is what Sharon had already shared with us. So I'll turn it over now to Finance. DT?
I think our first item on the agenda is from our general counsel.
Thank you. I don't know if this is magically going to load like it usually does, or if I need to.
There you go.
Look at that. Magic. So thanks for allowing me to present today. We realize that we haven't really had much opportunity to present to the committee some of the behind-the-scenes work that the team is doing around contract management. So we want to make sure that we're updating on that work that's going on. So as we continue to implement changes, that the committee is aware of our goals as you all experience some of those changes. Sharon doesn't believe in magic. She brought me the clicker, so I will advance myself. So the first thing I wanted you all to know, if you're not aware, that actually the contract management team functions as a part of the overall legal department. So they are a team that reports up through their executive director and my deputy general counsel as part of our team. Some of those responsibilities that they have, which this is just a brief list of those, they're responsible for contract template management. We do try to have templates for many of the services that we provide so that we're not reinventing the wheel every time that we contract for those services. They're responsible for interactions with contract owners, and those are the individuals within JPS that are requesting that we move forward with certain arrangements. They're responsible for ensuring adherence to procedures, including all required approvals, and interacting with vendors and obtaining final signatures on the contracts. And this is a very, very high-level overview of just the basic life cycle of a contract, just so you have some perspective of what we do before a contract actually makes its way to the committee for approval. There's lots of variables in this process. I mean, sometimes it gets a little bit circular in those middle two arrows. And what we're always doing is assessing where we can create additional efficiencies in the process. So you'll see that it starts off with the contract request from someone who's looking to move forward with services, and that's where we will evaluate whether or not the request requires competitive bidding. And then we'll also, prepare that initial contract draft, whether or not that's embedded in the competitive solicitation documents, or whether that, if it doesn't need to go through that process, just getting that initial draft of the contract out. And then as we move into that initial draft phase, that's when you'll have more weigh-in from the attorneys reviewing any changes to that. We'll be interacting with vendors during that phase, and then the negotiation. And then eventually we'll get a final draft. So sometimes, again, that negotiation phase is where we see a lot of our time can be spent. And then we'll get to the final draft and attorney sign-offs, and then that's when it progresses for approvals. And there's various levels that might go through. It might stop internally if it's within one of our, or Dr. Duncan's approval authority limit, or obviously if it needs finance approval, the board approval and commissioner's court, we're responsible for making sure that those things happen.
Is it our preference to use on paper and interchange it, or
It's always our preference to use ours. There are, some unique services, especially like software contracts and things like that we won't have templates for. But as I mentioned, we're continually assessing this, and if we see that we've requested a certain service multiple times, we will begin to prepare our own template around that. What we also do is, for those that we are going to start with their template, we do have what we call our government addendum, that if it's quick to just kind of ask them to add that on to whatever document they are. Because sometimes it is hard to negotiate those things. They, like us, we're like, here's our agreement. Do you want it?
Thank you.
They're the same way, right? Some of them are big companies they're just not going to entertain a lot of changes, but typically they are willing to accept our add-ons if we feel like there are certain things that we have to have as a governmental entity.
Okay.
At which stage do we identify, is it budgeted or not budgeted items and all that stuff? Or?
Yeah, so that is part of it, and thanks for asking that question. So that it's part of that initial request phase, and it is information that we require as we begin to prepare those executive summaries. So there's an additional process that flows along with this that includes that, making sure that it's budgeted, where is it going to, where's that money, where are those dollars coming from, and has it received other approvals that are necessary before we even get to requesting a contract. So as we assess what our needs were in order to do the work around improving our diversity spend, it occurred to us that the contract management team is likely in the best position to gather this information from vendors. So I'm not sure if the committee was aware that we actually now own that process. So we had a newly created role. It's called the Vendor Relationship Manager. We have an individual that we hired not quite 2 months ago, I believe, and his name is Cody Deeds. He works for us. He's primarily responsible for those initial interactions with vendors, managing the vendor portal, gathering information on diversity spend commitment and tracking the actual diversity spend, and also facilitating evaluation of existing vendors annually and at renewal. That is a bullet point is more directional. I mean, that is going to be part of his job. I know the board has asked about that consistently, so we are, revamping those processes to make sure that that is occurring.
Can we get some reporting on some of that diversity?
Correct.
Routinely? Great.
Correct. And not just the diversity, but overall KPIs for the contract. Correct. That's why I looked at you when those two bullets in there.
We pulled up all the past board meetings, looked at all those questions.
When it comes to software application, it's a little bit more complex. So does the vendor relationship manager own that process? Because the challenge is that we have so many turnover over the years. So the people in the seat doesn't know why we have those software, or they may thought that it's part of a bigger software solution, and IT just moving the process forward. So at what point, how do we develop that skill set so that when say, this request from that person is no longer here for 2 years ago, now we need to move on to do something else, and how do we collapse them and stuff like that?
Correct. So we should be getting some of that information from the team. We've actually I know Will is doing a lot of work around how we go about vetting, the software applications that the network will use. And so as he continues to evolve that process, what I envision is that it becomes part of what's embedded in kind of that annual review, and as things are coming up for renewal, we have a better appreciation for, why the decision was made. Is it something that we continue to need? If somebody's asking for something that's different or that does the same thing that existing software does, we'll have more robust discussions around that. Does that answer your question? Okay. So here is probably something that you all have wanted to see for a long time. This is the diversity spend dashboard. We're extremely proud, actually, that, we're sitting at 24%, and I'll give some more context around how we are getting to this number. And this represents the net new committed spend since October 1, 2021. So as we set those goals for last year, we decided we were going to say, let's see how we're doing now that we're putting more robust process around managing that diversity spend.
And when you say diversity, you mean certified MWBE spending?
Correct.
Or contract? Okay.
Correct, yes. And that's how we define it in policy. So as we use that term, that is what we're referring to. Yeah, tier one would be that the MWVBE vendor is sitting in that prime seat. Yeah, and tier two is the subcontracted spend. And you will recall that I think the last report outs that you were receiving, because we have been trending up for this past fiscal year, I think we were sitting at 7 7% when we started this work. Yeah, so we are really, really proud of this. This is all, yes, this is both, and I'm going to get to a slide that is just bond-related.
Okay. Is it fair to say that 75%, we may not have a lot, we may have impact, but not a lot when it comes to sole source? That we don't have a choice?
So.
I'm looking for opportunity, that's why.
Yeah, no, so are we. So just so you know that for those areas of, we did identify that in that additional spend, and this means that in that gray area, the 74% or the 76%, that we continue to drill down on that. So these are items that are by definition excluded from our diversity spend calculation. So we won't give ourselves credit for that until we decide that that is no longer a service that needs to be in that bucket. And what we found is that in that gray area, there was actually 33% MWVBE spend. Correct. So I'm not ready to say where that's coming from yet, but we are drilling down on that to see if we have additional opportunity. Does that get your question? I know that you always want to know if we're looking at that, and we are looking at it. And when we get to the evolution slides, you'll see what we're going to be doing around.
I'm looking at, like, let's say Epic is the most expensive item in here, but there's no way we can apply that because it's literally you choose that and anything else attached to it is sole source, right? You can't go away from that. So that prevent the ability for us to go out. I didn't want us to be penalized by that whole number.
Correct. So it's not in our, and I probably am speaking wrong. So this is where, these are numbers, it's not really, the 76% I'm talking about is not really reflected here. This 76% is, of this whole pie, these are things that are not excluded. So these are the total dollars that are in those categories that would be included in the spend. Okay. And then the numerator is the spend achieved. Okay. So outside of that, not referring to that pie, in those excluded categories, like where Epic would fall, because then we're seeing that there was another 33% that we would have actually achieved if those were included in this spend. So we would never be counting something like Epic where we can't get, MWVBE spend from anywhere. That's excluded by definition from our calculation.
Right now.
Correct.
Encourage all of them. Sole source and a lot of the IT, in which we've thought in the past we were not going to be able to reach or have any diversity spend. We are reaching out to them to let them know that we'll continue to evaluate annually how they are progressing to have more diversity spend.
And not only that, even if there's not that opportunity, for instance, if you're buying a widget from a company that makes the widget, they're not going to subcontract with an MWVBE vendor just so that they can say they have some spend. But we want to know, what are you doing in the areas of diversity, period? What is your workforce like? So we still ask questions around diversity initiatives, even if it's not something that's going to be included in our calculation.
Yeah, because my concern is that when I raise the issue, I'm not reading it just employees who are doing work for us, but what your whole workforce looks like.
Correct. And you'll notice that on our executive summary, we've updated that to reflect that question. And we have a whole process around asking that information from those vendors. So we don't get any credit for it in this calculation, but we still are making sure that we are, we're going out for business with those companies that are committed to diversity overall.
Because I think you'll find that if you look at the entire picture, they reached the goal, so that's.
Ability to take that 24% diversity spend and break it out by women-owned business, minority-owned business, veteran-owned business,
So we will have a better opportunity to do that when we get to kind of this evolution phase, which I'm going to talk about, which is software-driven.
Okay.
You know, most of this has been pretty manual.
Yeah.
Because we didn't have a tool to really do it. So we should be able to do more of that drill down.
Let me ask you a trick question. I'm going to be clear.
Trick question. I'll give you a trick answer.
What if they set shop halfway around the world? Is that considered a minority? Or they run a shop with H-1B visa? Is that considered minority? Because for me, it's not. But
Say that one more time. I heard about
I didn't
the,
hear the first part.
what if they set the shop overseas? Is that considered minority? And then what if they run a shop with H-1B visa? For me, it's not minority because we're trying to address the community needs, right? So that's just.
right. Goes back to that certification, but I don't think that would fit within our definition of what we consider to be included in that spend.
Sometimes they can answer it differently, and to me, if it's H-1B visa, it's questionable for me, right?
No, I hear you.
The people that are doing the certification, we'd have to look and see what their criteria is. And I think they asked that. It's kind of tricky when we.
Not sure if they even go that far.
I'm trying to think about when I had to provide that information. I'll go back and look at it, but.
And I don't have an example specific to that, but I will say just in terms of the information that the team receives, I know that there has been at least a couple of occasions where they've had a company who has indicated that they would be able to give us a significant diversity spend, and they've actually caught when those individuals fell out of that category. So I don't know about your particular example, but I don't think that hits our definition. Now, if they did something cute to try to hide it, I'm not sure how we would catch it, but, I do know that they pay attention to that stuff.
Because I know the discussion, it's go beyond diversity, right? Because if you have your data sent overseas, we may have some security issues.
Offshoring, yeah.
And that might be another trigger for us to look at and say, wow, this is overseas, we can't have that.
Yeah.
Yeah.
We do have some other prohibitions around offshoring, but, so this is the question I think that you all have been asking is around bond-related diversity spend. And right now, the number that we are going to report out, that we are confident in reporting out, is the 28%. But I will tell you that, oftentimes with a lot of these construction projects, what you have is that you'll have a contract that has committed spend, but that spend has not yet hit. And they may have different projects in the contract that, for this project, they may be able to subcontract out a certain amount of the work. And so when we look at that, what we did do is at the end of the year, our new vendor relationship manager did an audit. And so for those contracts that were bond-related contracts that had additional committed spend, if we just looked at that in terms of what we might be able to achieve overall, we're sitting more at 34.8%. So we are confident that that's going to continue to trend up. And I know Adam's team is doing a good job of holding those vendors' feet to the fire as well.
Do we have the capability to track like TCV, total contract value? That way we can see the whole thing. Is that the same thing you talked about?
Yeah, and that's what we base it on right now because, and again, we didn't give ourselves credit for it in 2022 because the spend hadn't hit yet. Right. But we look at total contract value, and then we're looking at percentage of committed spend in that. That is going to transition to actual real dollars spent, and I'll get to that slide in a minute.
I see. You have any UT grad on your team because they're using the burnt orange on there?
I'd have to go back and look at the default color when you create a graph, because we don't tend to get that.
I do, as a side note, want to meet the PowerPoint person at JPS because they do a fine job of putting together all of these.
You know, my team, we put together our own PowerPoint, so I don't know about the rest of them, but we do have whoever, created our template. It's
Fine job, fine job. Just don't object to the color.
I just want to say that I noticed that when we look at diversity spend, especially the bond program, that contractors are really becoming sensitive to the requirement of JPS on diversity. I say that because many of them stop by my office to introduce the diversity side before they get here. So I almost know everybody that's going to bid whatever because they come by Rising Star.
And it's about to get even more real for them. You'll see in a couple of slides from now. So relative to the overall diversity spend, this is kind of what that's looking like. Right now, it's 27% bond-related and 73% non-bond related. So that's relative to the overall diversity spend. That's not, where we're sitting. The bond-related spend as a function of just bond-related dollars is actually higher than the non-bond related spend. But this is how that first pie that I showed you, kind of how that splits up. Thank you, Bill, for breaking that down for me. So this is kind of the evolution of how this will work going forward. So we're really trying to move from the calculating this based on committed spend and making sure that we're really getting from vendors what they say they're going to do. So this is moving into what we call B2G Now platform. Our vendor platform actually runs off of B2G Now currently. This is another aspect of that platform that we came to know about as we started doing this bond work. And so we've been working with that team to get this implemented because this will give us actual tracking of spend. So this is a vendor interactive tool. They have to go in and actually validate information and give us actual spend numbers. We are told that a number of vendors are already accustomed to this. We will be, again, training them on the system for the ones who are not. American Airlines does their tracking through this system. So we're hoping that now we're going to get even more precise about the numbers. And the reason we've been flogging the team is because I'm like, we better not be, doing this as soon as we, report out from this system. So we've been working really hard on that. I did just throw on some scheduled milestones for the implementation, just for your information. And the blue highlights are probably the most important to you. We've already sent out initial notices to the registered vendors that this will be a tool that they'll be responsible for interacting with, and they'll get a second notice the 15th of December. There's a lot of work that we have to do internally to get information into the system and get that all locked in so that the vendors can put their data in. But that January 2nd date is our official go live for vendors to be able to add payment information. So really what we're looking at is we just did this from the October 21 data so that they're going in and validating that. As you remember, we didn't enter, other than the program management in the program manager subs, we didn't enter into any bond-related contracts prior to that time. So this will be very accurate in capturing bond-related diversity spend. And then January 25th is when we're anticipating to get that payment reconciliation by the vendor. So we're where we're sitting is we think we're going to be able to start reporting out in first quarter with the information that we've gotten from the system.
So this is interactive between the contractor and our vendor management person.
Correct. In the system, we can run reports out of it.
So I'm a contractor, and I sign a contract with JPS, hypothetically, and I say I'm going to have 33% diversity spend. I put that into B2G now. We perform the contract. How does JPS know or verify that?
They have to verify it. So we actually, they have to go in and put in actual payment reconciliation. They're subcontractors. If it's not a prime, if they're doing it on themselves, we know that whatever we're spending, we can match that up. If it's subcontractors, then whatever they put in there, their subcontractors actually have to validate that information as well.
So do you know?
It is.
For the vendor that Roger speaks of, is there a licensing cost for them, or do we pay the licensing cost? The only reason I ask that is if it's a small vendor, is it prohibitive for small vendors?
Correct.
To access?
My understanding is that there's no additional costs.
We probably pay the licensing cost, I would assume.
It's probably built into our pricing. I would presume that as well. So there's no additional, as we add them, there's no additional costs.
Do we write that into their contracts that they will have to use B2G now?
We are planning to do that. We're planning to actually add it, especially with the competitive solicitation documents.
Okay.
These will be additional requirements. So as we continue to evolve, I just want to mention some of our evolution goals. And this includes the overarching contract management function. We are refreshing our procedures and plan to have those available in a comprehensive purchasing manual. Right now, there are existing policies and procedures, but they're just in our policy tech database. So anyone that wants to know how to get through this process or where to find things is going to have to know which policies apply. So we're building that purchasing manual, so it's like all comprehensive. Creating a larger database of templates based on frequent purchases. We talked about that earlier. Growing the team to offer end-to-end purchasing services. What I mean by that is right now we are definitely a collaborative unit in terms of getting a contract over the finish line, and our operators have to be significantly involved in that process. So my goal is that eventually we will have enough members of the team that we can do the bulk of that work and do the negotiations and manage that for them, so they can just come in with their request and then we can handle the rest and get it back to them. Now, there'll still be some interactions, but right now there's a lot of interaction of the team. And then a more comprehensive executive summary for the Finance Committee. We've done some of those initial revisions, but the goal is that you will be looking at a comprehensive executive summary and not having to rely on those other supporting documents to get the information that you need for your approval. And as usual, I'm not asking for any questions, but if you have any, I will attempt to answer them.
As you're thinking about questions, I'd just like to thank Daphne and her team for this heavy lift. And as you were saying, it's these projects, just truly, I'm just very proud of. It's been long overdue, and for her to take this on and to build it in such a short period of time as we were working through the bond and ensuring that we would be able to report out our diversity spend. I just want to thank Daphne and her team. I know she's made it seem as if it was an easy task to do, but I know she has spent many evenings working with her team and interviewing to get the right team there. So thank you, Daphne.
Thank you.
I do have a quick question for you. Because we're going to be spending $1.5 billion, so I want to make sure that, we don't end up in the newspaper down the road, because there will be people gaming the system. So if the more we tighten up the process and hand off, that way, everything is transparent. That way we don't have to worry about, people game the system and down the road we got ourselves in trouble. How would we gain that knowledge from contracting so that the people on the ground would know this is the exception, this is what we'll be looking for, so that way it start out correctly, so keep everybody honest at the same time.
And are you talking specific
I'm trying to put Collins out of his job, because once compliance jump in, we have issue down the road.
Are you talking specific to how we're assessing for diverse spend, or just the overall process?
The overall, because all of that stuff tied to the contract, and that can be hundreds of millions of dollars for some. I just don't want that to be something that people can game the system.
Yeah, so as I kind of was mentioning, so we do have our procedures. We give them lots as the competitive solicitation is going out. It contains a lot of information about our expectations. And I think the board was instrumental in saying, we're going to follow our processes in terms of how we vet these vendors and how we score them out before we make an award. So we adhere to all of that. If we're going to negotiate on any of the contract terms or the scope, there's a process for that. They have to give that back to us. We will share that with other vendors. Like if we're going to reduce the amount of insurance that's required because one vendor has said, I can only provide this much, we're going to let the other vendors know that, hey, we will agree to accept these limits. So we're through the process communicating and making sure that everyone is on the same playing field. Did that answer your question? I'm not sure if it did.
No, I'm more,
Still have to use common.
I'm more into sign off and all that stuff, and making sure that, whatever.
Kind of auditing the process, making sure it
along
went.
the way, so that we don't get too
that'll
far
still
out,
happen.
and then it's hard, to go back and take back the money or they already spent, and,
Correct. So I think it's twofold. I think, the work that Collins' team does, and then again, adding these kind of annual reviews to make sure that we're getting what we're supposed to. And then from the payment perspective, you're talking about making sure that we're only paying the amounts that were approved under the contract. The system will actually track some of that, because we'll be able to get direct payment information in there, and we'll have to match that against what we've put into the system.
and that will be the vendor relation person that you hire will be managing all of that. Okay.
We may be, eventually adding a couple of data analysts to the team at some point, because it is, once we got into this, we did, realize that it takes more people on our side kind of managing that information. So we do expect that we'll be adding other people.
Those will be unbudgeted items.
It'll be budgeted.
No, thank you.
I'm glad to hear that we'll be dealing with or being able to fluctuate insurance requirements, and I don't know how we deal with that on bonded jobs, but that's something
That
for
was,
later.
for example.
But I'm glad to hear that, because I still don't think that the restroom partition guy should have to pay a bond premium on a restroom partition. So, that seems kind of silly.
Yeah, we look at that all the time.
Yeah, the steel guy, yes, and the AC guy, yes, and the
Right.
electrician, yes, but, so that's good. And I'm glad that the system will track that. In terms of specifically bond payments, I know that we have an average day to pay on invoices that come in. Have we looked at that and set expectations to the contractors that JPS makes a promise to pay within 45 days, within 60 days? So they know up front that they're going to be carrying a capital expense.
Usually is in the contract, like when payment will be due, like we'll
Yeah.
negotiate that in there.
Well, when payment, it's typically paid when paid is how I see most of my contracts. But we should be able to give them a reasonable promise that that you'll get paid 30 days, the prime contractor will get paid 30 days after they submit their pay application, and it's been approved, which typically means about 45 days.
I don't know who's negotiating your contracts. That's usually in there. I mean,
Well-
usually they want to know in what time frame. I mean, there's that
Right, but,
negotiated up front.
Regardless of whether it's a minority contractor or a non-minority contractor, or whatever else, contractors live and die by the payment and the payment cycle, and it's all about cash flow. And I've seen big contractors and big subcontractors, and I've seen little contractors and little subcontractors go bankrupt simply because they're not paid timely. There's a very large
So you're
public
asking
institution
about, do we hold
in the
the
middle of the
contractor?
Metroplex that has put plenty of contractors out of business because they're not paying on time.
Yeah, so you're asking me a different question. So you're asking, do we have a requirement for how soon a contractor would pay their subcontractor?
In both
Those
ways.
are usually,
Yeah.
So that could be a little bit trickier because that's usually a separate contract between those two parties.
And
but we
state
can-
law dictates some of that stuff. They have 7 days or 14 days once paid, whatever. I just want to make sure that we're cognizant of that because we can hire all the small contractors and all the minority businesses in the world and bring them on board and have them working and put them out of business just as quick.
Right. No, it's a good point. So I can look at what we're doing around that and if we have anything in there.
Yeah,
that
I know
requires
state
that.
law dictates it, but typically, in my experience, it hasn't been that the general contractor has been paid and they're not paying their subcontractors. It's the owner hasn't paid the general contractor, therefore the subcontractor is not getting paid.
Okay.
So I just want to make sure of that.
Yeah.
And then we are hoping to see one day that we'll see diversity spend. Hopefully, we'll be able to say that these are minority-owned firms, these are women-owned firms, these are veteran-owned firms, all the different categories. And then there's the things that we don't get credit for. How do you expect to show us that workers based on this ethnicity spent this many hours or this much money, or will we see it that granular?
It might not be that granular.
Okay.
I think what so there's this entire bucket of dollars where we know that there was spend in there that would have qualified under our definition, but currently it's in an excluded category. What I understand is that from this database, we will be able to at least tell where there are other vendors that should be in an included category. So we'll be able to start assessing whether or not we should not be excluding that spend and whether it's included. I don't know if we'll get as precise on some of those other things that, that are not popping up in that system as categories that are already being tracked. But I will be able to tell you more.
Well, I was just trying to figure out exactly what we're going to see on the stuff that we don't get credit for.
Correct,
So
correct.
I'll see it when I see it.
Well, yeah, sorry I don't have a better answer. But I think it's because we're still digging into that to see what all that includes and why it is that it's currently sitting in an excluded category when clearly there's some opportunity there. So as we continue to drill down on that, we will report out what we can and, let you know if it's capable of being sliced and diced further.
I want to piggyback on what Roger was asking for the subcontractor. When you use minority interest, sometimes you don't get paid until you finish the big project, but they still need to pay on a regular basis. Is there anything we can put in the contract that if they don't, we may reserve the right to pay, and then we'll settle with them, and then plus penalty or whatever that is, because we have to do a lot more work to be able to verify that's the amount that needs to be paid and all that stuff.
Yeah.
Because they can go out, especially big items where, I think big contractors, if you ask them, they do have a program when they're trying to pitch to see when they're going to pay the small contractor.
Right.
And usually they pay them ahead of when they get paid. But
Yeah.
that may not be all the case
Right.
unless we put that as part. I'm not sure legally can we put that in.
So
as
I'll
part of it.
defer like a specific answer on how we would, create a contract term around that. But what I will say is that because as we use the B2G Now platform, it will be transparent. So they'll know that we'll know whether or not they're paying their vendors, right? Because the subcontractor will have to validate that information. So I think that transparency is going to also drive some of that accountability. But I will give some thought to, what kind of teeth we can put in, making sure that they are not only paying their subcontractors as what they've committed, but that they're paying them timely. So I'll look at that.
Well, and keep in mind too, the further you get from the prime contract, the more difficult it's going to be for you to get information, whether they're required to enter it into a computer or not. Sometimes these firms are two people. I mean, so just keep that in mind. If a subcontractor or a subcontractor is doing work, there may be holes in that verification process.
In terms of them actually validating it for us? Yes. Yeah, we'll see how it goes. I'm told that it's, at least for other companies using it, it's been working well. But, and again, the reason we'll have a team dedicated to it, sometimes that is picking up the phone, hey, you haven't validated this information. So we will be able to talk more about that as we see how it's going through, the early implementation phases.
Excuse me. Thank you. This is a lot of great work.
Yeah.
I fully support it, and I can tell from what you've done, like this is a lot of legwork and person hours that have gone into it. Right? And I think one of the things, if you'll allow me to frame it for about 30 seconds, it might address part of their concern too, but are there some points as this moves on and you start to report where you can say, hey, this is pretty successful, and start to kind of, get credit where credit is due, and for all the hard work that you've done, but also to put some awareness about this out in the public so that they don't have this issue when they're, that it's expected that this is what they're going to provide to us in terms of their contracts, and help, hold everybody accountable to make sure they get paid out.
Right.
And I mean, I don't know if other like-sized institutions are doing exactly this, or if you're the leader. I suspect the latter, and I mean, this should be a feather in your cap.
Well, thank you. I don't know that we are, though, unfortunately. But we do, in terms of education, and to your point, we put a lot of information on our vendor portal. And so we do, and we just using the bond work, for instance, we have kind of outreach efforts with our, a third party who's one of the subcontractors on the bond work, to direct kind of those vendors to use that portal to get information about how to do business with JPS. We've created a how to do business document. We will have more information for them about how to interface with this platform and sending those letters out. I don't know that we haven't done anything expressly around, hey, this is what our contract management team is doing, and these are our efforts around diversity. But we do try to get information out to the vendors for sure.
Yeah, it sounds like you're doing a great job with that. I was kind of thinking more broadly in public awareness.
Yeah, no, I hear you. So we can definitely do something internally we hadn't thought about, beyond JPS. But we did recognize, to your point, that, we have a real opportunity for educating our internal teams around processes and how all this works. And I'll give some more thought to, how we could do something more broadly. Yeah, for sure.
If it looks as good as I think it will, then
it's exciting. Yeah, we're thinking
that.
it's going to look good.
But one thing you realize is that whether you market it and share it or not, contractors share it. And it gets out there for sure. Yeah. It does.
Always.
This should really give the board confidence. I think often there's a lot of questions when we bring contracts to you as to how we've worked through them, and how we can have more standardization and policies around it. So I'm hoping that this gives the board confidence as we start to bring contracts through. I'm hoping that we have fewer contracts as Daphne's team is working to keep those small kind of contracts or requests that have previously been asked for when they don't need to be asked for. We can just amend an existing contract, all of that. So again, thank you, Daphne.
The hospital put out numbers and all that stuff for statistics, data analytics. You can do whatever you want to do with it. But I think this one has built from the ground up, give us the ability to measure, transparent, and then also make it impactful. I think it's for long lasting. It's not just one-time things. This is, and I really appreciate all the work that you guys put in for that. All right, I'm not going to entertain anymore. I'm going to take the control back, and we're going to have a CFO report. Yes, Shannon.
Thank you. Given the time we have left, and we do have something to discuss in closed, I'm going to try to do a bit of an abbreviated version today. But it is the first month of a new budget year for October. The good news is that we had a positive financial outcome compared to budget, so that's always a good way to start the year. The story this month is really more around the inpatient volume was higher than budget and higher than trend. You can see for up in the top left graph, our medical surgical admissions were up over budget by about 16%, and they were about 6% up from September. So we were busier. However, our acuity was lower and our length of stay was down. So that helped with the throughput this month. Our emergency department was higher than budget by about 4%. As you can see there, based on the trends, about the same as it was the last quarter. Urgent care was up 5%, about equal to September. So we saw some good continued volumes there. And although primary care and specialty care visits show under budget, we were at the September level. There were some provider PTO as well as some vacancies that we're working to fill. And we had budgeted for those volumes to be here, but they were right where they were at September. So constant volumes, but below budget. For surgery, inpatient continues to be strong. Outpatient really had a high volume for October. This was kind of across all specialties. You'll notice that it's not that unusual. We had a very high month in August as well. But budget was based on probably the trend through June. So you can see that even the last quarter of last year, we were up. Behavioral health is tracking pretty close to budget, right on budget for patient days, as well as clinics. Our PEC volumes were a bit lower this month, and you can see that with outside medical services as well, which is kind of the relief valve for those inpatients coming through the PEC. Some of the financial metrics, you can see that our FTEs per APD up on the top right was favorable. This is just for 1 month, so that will start to normalize as we get some more time under our belt. But our budget was 5.82. The actual is 5.64.
The contract labor?
Yeah, so we try to, there's a factor that we use to try to account for paid FTEs. For the hospital for the month, we did have an operating income of about 10.6 million compared to 9 million budget. We did have some underage in the net patient service revenue. Our volumes were higher for the most part in inpatient, but a little bit lower than budget for outpatient. And we did have a negative payer mix for October. Again, that's one thing that as we get a few more months under our belt, I'm not too concerned with just 1 month of unfavorability. Our salary numbers were about 2 million over. Most of that, about 1.5 million, is related to supporting the inpatient volume overage that we had. Another 300,000 or so are those shadowing new FTEs that are during their orientation period. And we did have some overtime due to the increased shifts created by the inpatient volumes. In the purchase service line item, we had some savings of about 2.7. About half of that, I think, is related to timing. There were projects, some things that were budgeted for in October that will likely catch up later in the year. So overall, a very strong month for the medical center. Are there any questions on the hospital side?
I'm not sure if you have visibility on the underpayment from Medicaid, managed Medicaid. Is that around coding, or is that around, or do they have financial challenge for the end of the year for them?
For the end of the year?
Approaching, they may slow payment or deny
So
payment.
I do know that the payers have continued to kind of lengthen the time between the payment. And then for the Medicaid MCOs, the CHIRP payments have been difficult to track for everyone. Is that kind of where your question is?
Oh, no, I was questioning because it's in your summary, it said underpayment.
Oh,
Paid to certain managed care
yeah.
to pay us on claims.
So that is more of a realization. We accrued to what was expected based on our contract.
Okay.
So.
And they pay us under?
So I think what we're talking about there is not necessarily the underpayment from their contract. It's just the way that the services occurred, that we did realize a little bit less from Medicaid this month. That's probably not worded correctly.
Okay, so
I'm sorry.
Okay.
Yes.
So it's not underpayment, it's just underpayment from what we budget for.
Yes.
Okay,
Yes.
got it.
My apologies for that.
Because I was looking, if they underpay us, they in violation, then we can go back to full
We
fee.
are, the HARP payment, we're accruing, I didn't mention that. And then the second year of our CHIRP payment, which is paid per claim, that's been slow coming in this quarter, but we've been accruing for it. So,
Maybe underpay compared to budget, maybe that's a better word.
Yes.
Okay.
I'll follow up on that. For a claim, they had a very strong month. We did change their key statistic up in the top left to build CPT codes. We were tracking procedures relatively. They should track close to the same. That was, they had a busy month with about a 15% over bill CPT code from budget. And that shows up in the net revenue on the top line. For the month, their operating loss was 1.1 million compared to a budget of 3.9 million. Up in that top line, there's about $500,000 of net revenue that really belonged in the prior month. So we're doing some catching up there. But the other part of that was due to that increased volume of about 15% CPT codes. In the salary line, there's also some savings there. The comp plan was budgeted to begin on October 1, but that will begin on November 1st. So my estimate is about a little more than half of that 900 of savings is due to that 30-day delay. And the other portion is due to some open provider positions that they're currently recruiting for. So when you look at our combined margin towards the bottom there, as a combined entity, we are at $9.5 million compared to a $5.2 million budget. So we started off October about $4.3 million favorable. Some of that is due to timing. You will not see the November financials next month because the meeting is so early in the month. So I'll be presenting November and December at the January, or I guess the February board meeting, but the January Finance Committee. So that will give us a better feel and hopefully remove some of that timing.
Any things that out ordinary that we should be worried about in November as we sit today?
I am not aware of anything unusual in November that will impact the financials. I think just a little bit more of the same that I pointed out will continue to accrue. I do accrue for the HARP payment that was unbudgeted. I do think that salaries may take a month or two to right size as we onboard all of these individuals, and especially if that inpatient volume stays high. We'll have to fill those extra shifts and get those people trained where they can be productive and for patient care.
Since we don't have that number for next month, if anything out of ordinary, would you let us know so that we can alert the executive team?
Absolutely, yes.
Just in case. Okay.
Yes.
How many nurses were we able to recruit, and how many are we shadowing? Do you have that number?
I don't have that number, Dorothy, but I can get that for you.
Okay. All right, because I'm concerned that we're over salaries, and I know we paid high premiums, we had overtime. When we did the budget, I was under the impression we was increasing that because we knew that that was going to continue. We had already added in the increases, so that large salary dollars just kind of, for the first month, is kind of troubling. So
yes, what we did, and again, that was 1.5 million of that, 2 million is due to volume, the inpatient volume that we had come through, the 15% higher admissions. So there's still about 600,000 in there. That was over. We did keep the salaries constant. We didn't increase that premium payment that we were experiencing from last year. So the budget does include kind of a historical trend, to your point.
it should be able to show you an increase in a large number of contract nurses because they're not out there. So that,
Right.
I mean, even when your volume go up, there isn't a pool that you can just pull in. So that's one of the questions I kind of like to see. If we were great in pulling them in, I'm happy. But I just think that there's some concern for me there. Okay.
Well, we'll watch that, and the training, the larger dollars kind of in order were the emergency room, which has the newer employees that are coming through, acute nursing, and behavioral health inpatient. So those are all areas that I'm aware of that had high vacancy, and we're trying to get those positions filled.
Yeah. So ER did a presentation at Quality showing they still had a large number of vacancies. So I just want, that's my concern on nursing. Okay.
All right. We just need a motion for approval.
May I entertain motion?
Second.
All in favor?
Aye.
Opposed? None. Motion pass. Next, thank you.
Thank you.
Next item is Zelia. Welcome. How are you?
Good morning. I'm doing great. Hey, everybody. Happy Thursday, right? Okay, I'm here today to present to you for your consideration 2 contracts. We'll start with the first contract for consideration of your approval between Tarrant County, MHMR of Tarrant County, and the Tarrant County Hospital District. The cost is for almost $1.6 million. It provides funding for specified county-wide behavioral health and intellectual disability services to be provided to Tarrant County residents under the auspices of MHMR of Tarrant County. And it does provide a refund to the district of any unexpended or unencumbered funds at the conclusion of this contract. It does align with the district's strategic plan to improve patient outcomes and increase access to behavioral and intellectual disability services. So these dollars will pay for beds at the Liberty House, which is a detox treatment program, which we send a lot of our patients to. Court liaison and aftercare services, which they operate here at TSP, because we do probate court here for the whole county. Adult mental health peer support, which benefits our patients in the outpatient setting. Children's services, and intellectual and developmental disabilities. Again, we're able to send our patients with IDD and other developmental disabilities to MHMR. And it also helps pay for behavioral crisis services for Tarrant County, which, of course, those are our patients as well. So, yes, sir, with a 30-day out clause.
I noticed that it starts on October 1st, so is this retro back to October 1st?
It would, yes, sir.
Okay. Right. Any,
Yes, it is budgeted, my bad. No, sir, we've done it every year since I've been here.
Okay. Yeah, I asked that.
That's the new one.
I asked that because have we received any refund from unexpended funds? That's what I just said.
Yeah.
But it's in there.
We have not,
Yeah.
but not, let me just say, not yet.
Okay.
There's always a yet.
Move approval.
Second.
Aye.
Thank you. Yes, I'm here again for you to consider approval of an interlocal agreement between Tarrant County and the Tarrant County Hospital District. This agreement is a 1-year term for almost $19.4 million, and it is included in the approved operational budget. The strategic plan alignment, it provides funding for specified countywide behavioral health services that, wrong one. I'm sorry, but it provides funding for Department of Public Health as well as the MHMR to provide mental health services at the county jail.
So you actually got a refund? You're actually...
So that one-time credit was from Public Health
okay.
for $818,958.
Oh, okay. All right.
Yeah.
Right.
Yeah.
Gee.
do you recall how much was the contract last year compared to this budget?
So typically, Public Health is what, a 3%.
Please.
And then with the MHMR contract, it's an increase of almost $1.4 million over last year.
This also back to October 1st.
Yes, sir.
Entertain motion to approve? Any second? Although I was going to table it for next month. in favor? Any opposed? Motion passed. Thank you.
Thank you, and thank you all.
Mr. Lane.
Good morning, everyone. I have two contracts for you today. The first contract goes right to the heart of what we were just talking about with the nurses. It's for roughly under $800,000 with Morales Construction. This is for nurse training space, a sim lab for the nurses. We had two respondents, and Morales Construction represented best value. Jill Farrell couldn't be here today, but she wanted me to provide a few comments for you. Current state, we have 5 cohorts per year. This increases the number of cohorts we have per year, so we have more throughput for bringing in more nurses. We currently do not have a sim lab. This gives a 3-bed sim lab. It's the basic standard of health for any health system that we should have this. Also, it expands education for nurse extern programs, PCT training, OR techs, and SPD. Also, it meets the requirement for the AHA training, and we happen to be the central training space for all of North Texas, so desperately needed space for more nurses.
And any question for Adam?
Where is the intended to be located?
The HIM space in the basement that's currently vacant. And Morales Construction is 100% hub, which is, and it has nice binning.
Can you define best value contract? Or best value bidder?
Best value bidder.
Or let me ask, is there a standard for a best value bidder?
Lowest cost, typically, if not lowest cost, folks that are able to actually complete and have value within their bid, meaning that they have the subs and folks to complete in a timely fashion, whether it's schedule or cost.
Is there I guess when you receive the bidders, it goes through the standard scoring metric or rubric? And that's what determines best value?
That's correct.
Thank you.
If no more question, motion to approve. All in favor? Opposed? None. Motion passed. Next item, please.
Next item, board may recall last year you approved $10 million in infrastructure for 3 projects, generator project, chiller project, and the structural repairs of the underground plant. The structural repairs have been effected. They are complete. This is the last phase of that component, which is relocating the electrical cable feeds between the generators and the main hospital. If you may recall also, we showed you pictures with calcifications on those cables. This is the lowest cost alternative that we found to rethreading those cables. It does not make sense to rethread the cables underground. We are creating a bus duct that goes overhead between the hospitals. That gives us best value for the next 6 years till we move into the next location. So instead of spending multiple millions, it's $1.3 million. This is between NTO and Tarrant County Hospital District. And they are 44% hub participation.
Is it going to be high enough so zero RV can pass through it without hitting it?
There's no truck traffic or any traffic underneath.
Any question? No? Entertain motion to approve? Second. All in favor? Opposed? None. Motion passed. Thank you, Adam.
Thank you.
At this point, we're going to move into our executive session. Let's give it about 5 minutes and then we'll start.
Give us 5 minutes.
Item that we need to take care of.
We are requesting approval for the sale and leaseback of Tarrant County Public Health Building and Women's Properties at 1101 and 1201 South Main to Tarrant County by the Tarrant County Hospital District, JPS, for $17,143,578.
Are there any questions? Okay, there being no questions, I will entertain a motion for approval.
Move for approval.
BT?
Second.
Second, Ralph. Okay. All those in favor of approving the sale and the leaseback signify by saying aye.
Aye.
Those opposed by nay. Motion passes unanimous.
Thank you.
Okay, there being no further business for the Joint Board of Managers Finance and Planning meeting, we are adjourned.
As you all know, I risk sounding the same, but it truly has been a tough industry to care for, to recruit for, and JPS is we're going through the same pain points as other hospital systems across the country. But I'd like to give you a little more information on that, go over our scorecard, some efforts around our recruitment and retention, an update on our employee engagement, which we just finished last month. So we'll give an update on that in our diversity, equity, inclusion, and belonging work as well. So as far as the healthcare industry is concerned, as you all can imagine, I'm sure as you all might have read, entry level is becoming a pretty hard to fill positions as we are competing against retail. And again, this is a huge challenge across the different hospitals in the nation. Patient safety assistants, multi-skilled technicians. We're competing against retail, the clothing industry primarily for these positions. In the local market, there's a huge need for entry-level positions, and it's amazing in Fort Worth how in a 10-mile radius we have about 7 to 8 huge hospital systems, just to give you an idea of where we are experiencing some pain points. And as you all know, the level of burnout is still quite constant as we continue to work with contractors. What that means for hospitals and for JPS is we're always orienting new people. And that can be tiring for some. Just to give you an idea, in critical care, in the ER, high-level volume of patients, especially from a level 1 trauma perspective, to orient constantly can also be taxing on our workforce. So we are obviously looking into innovative ways to recruit permanent talent. The nursing profession is still the highest turnover nationally. Unfortunately, the projection is that there will be more demand than supply, and so the projection is kind of gloomy for healthcare. Not something, something that we've seen in the past, but it just creates a new layer of complexity for hospitals. And I want to bring this up because this is a dilemma for all of us, right? Increasing salaries will drive up cost. We know that. But at the same time, keeping salaries down will drive some, not all, some of our nurses to quit. In fiscal year 22, 34% of our voluntary termination was based on pay and benefits, and also career advancement, which is keyword for pay and benefits. So we continue to experience that. This is a team sport. We have to take a holistic approach in how we retain and recruit employees, and we're exploring different ways to do that. Let me share with you our current recruitment and retention. Just to orient you on the slides, as you can see there, on the left side is all of JPS network, and I wanted to give you a good view of where we are from a nursing perspective. As you can see, beginning in June, we have increased our recruitment month over month, and the trend is going up as we doubled our capacity in orientation. We've identified a lot of our critical positions where we are putting more resources, primarily, again, in nursing, ER, critical care, med-surg, women's. But I will say that it's a very hard task. It requires, not just from a recruitment perspective, it requires us to have a robust marketing strategy, robust onboarding, and working very closely with our leadership team. There's good news on the horizon, on the other hand. As you can see, our termination is on the downward trend. Now, it's not a steep downward trend, and so we don't know how long this is going to go, when we are actually going to normalize and stabilize the healthcare industry. But the good news to us is we are making strides. While they might seem baby steps, we are headed in the right direction.
Yes, sir.
Go back to that. Termination, is that voluntary or involuntary?
This graph right here is combined. Combined voluntary and involuntary.
It'd be good to see what that breakout is.
Sure. Actually, let me look through my file here, if I have
And what is
that.
linear?
I want to say that 70% of our total turnover or termination is voluntary, and we have about 30% involuntary.
Linear is showing the trend.
Yeah. And as far as our contractors are concerned, as you can see, we still have a lot of dependencies with our contractors to help us augment our staffing. While we are focusing on stabilizing and strengthening our recruitment efforts, our contractors continue to be a part of our team, and we need them to ensure that we continue to deliver for our patients. As I was saying, from a recruitment perspective, we are coming together as a team with marketing, with the leadership team of JPS. We're looking at a new marketing strategy, social media strategy. We just upgraded our career site, and we are continuing to improve that so that we can tell our story of why JPS is the right place to join. We're also looking into a new applicant tracking system, and again, continue to increase our capacity from an orientation and onboarding perspective.
Carla, are most of these contractors, a couple of questions. One, is this represent primarily inpatient activity? And two, what is the percentage of nursing contractors in relation to all the nurses? So what percentage of our total staff is contracted?
About 12%. And this is only nursing inpatient, yes, sir.
Is that consistent with national norms?
Absolutely. In fact, some hospitals have more contracts than we do.
Thank you.
Yeah. Yes, you're welcome. Just to give you a view as well of where our vacancies are coming from. So here's a list of the departments and the positions with the highest vacancies. Always the clinical side is a hard place to recruit for. Again, local market, availability of talent, and just a steep competition. ED, critical care, women's respiratory department, med-surg, behavioral health, and radiology are the top departments where we have the highest vacancies at. And as far as positions, not a surprise to everyone, nursing, patient care support, respiratory, and a lot of our technologists across the organization as well.
Carla, do you want to speak to just even nursing schools and the fact that there are more individuals applying for nursing school than there are positions?
That's very true.
Really also,
yeah.
I mean, really kind of clogging the
absolutely
pipeline.
Right. And like I said, the supply is less than the demand, and even working with schools, they're not producing enough nurses for the hospitals, and you know, we talked about this last time, different hospital systems are getting innovative with their recruitment systems as well, as far as partnering directly with, increasing their capacity with seasonals, with residents, with international recruitment. So it really does require a multi-approach recruitment strategy.
Are we working with any of the university nursing schools to see how we can help them increase their numbers?
We are. We actually have really amazing partnerships with local schools in multiple ways. They support our residency program, they support our externship programs, and they also have a pipeline specific for JPS to go through their programs. And we do a lot of career, what's the word? Sorry, I'm lost for word. When we go out there and recruit for
for new graduates?
Well, we did have some of our staff became adjunct faculty so that we could actually help them increase their numbers. I don't know if that program went away, but that might be something that we need to look at. They want to increase their numbers. They do not have faculty. You have nurses that are graduating, or not graduating, that are retiring. They were one that, when we went through this one other time, they kind of we worked with them to do that. So that was all part of that overall community-wide effort that we were doing.
Yeah, and Jill's not here. She can speak to the conversations that she's having with the nursing school, and one in particular, I want to say is Texas A&M, but don't quote me, in which,
Come on.
to your point, in which we could do some of that training that's done in the school, that could be part of what we do. And also looking at it from state dollars and funding, kind of federal funding too. So there's a lot of conversation and work and how we can expand that.
Good. Okay.
Open. I asked that because I know I have a job board at the church. Then we could say, well, at least they could go by and look at the job board vacancies and look through that. The other is I'm a part of two large ministerial groups that at least some kind of way I could market that with those groups, or I could just say something, here's the openings at JPS.
Carla can probably speak to where you can get that now.
We could provide you some recruitment collateral as well, Reverend, and that could direct them to a phone call, to a phone line or the intranet for them to look for some of our openings.
And where to go.
Yeah, where to go, how to apply.
Openings is what is actually posted or requested, is what you'll see.
We can make that happen.
Should we look at hire them the year before they graduate so we can account for them?
Right, so that's a part of the externship program that we're building specifically with Tarleton University or Tarleton College. We're trying to engage with them from that perspective, but we have the same story and looking into the same partnerships with multiple universities so we can support them in that process and they become employees of JPS.
So for physicians like anesthesiologists and stuff like that, they got hired in that beginning of the third year residency.
Right.
For some of the top tier, they got.
Yeah. One thing that we've started as well, the RN residency program, we have increased that to 50 to 60. It used to be about 30 to 40, but we had to add more educators to build that capacity. And as Adam spoke to you all this morning, once we have a new space, we can actually further increase our capacity for our new grads to join JPS.
Do not miss the opportunity of getting some of the second-year nursing students that can do some of your MA work, because that's one of the key areas that you can recruit them. If we can work with the nursing programs as they rotate through, and we are a premium place where they want to be. So if we can get them to do some part-time, I mean, that was one of the ways that we really end up recruiting them. I mean, I know they changed the curriculum where they couldn't do certain things, but a lot of the things that your patient care support are doing, they can do.
Right.
Are you guys recruiting for physician too, or they go outside to different firms?
We have a team at Acclaim that drives physician recruitment, and we do have an internal team, and I want to say they might have a couple of partners as well, but we keep track of that. Right now, we have 25 physicians open and 27 APPs.
may sound odd. This is before your time here. Because we know we always have opening for a claim physician. Actually, I have one graduated last year, chief resident in family practice, UT Houston.
Oh, wow.
And the job was open, but when he applied, it said it's no longer available.
I can definitely pass on that information to our recruitment team.
Because that was the chief resident
Yeah,
applying.
that's a good point.
And so somewhere along the line, things are not add up somehow.
Yes,
One of the things I've noticed, I don't understand that whole process. I have a nurse at my church who's also the assistant director in our young adult ministry. I think we're at 5 now, young ladies she recruited because she's a nurse at Harris and recruited these young ladies to go into nursing, and they just graduated. But now they've gone to sign up for traveling nurse.
It's more money.
Because it's more
exciting.
Yeah.
Yeah. As a young person, that's exciting for them.
Yeah, they see the world. I
They
mean,
do.
my niece is doing the same thing. I decided I want to be a travel nurse, and I'm thinking, but 2 years from now, she'll be done with it.
Right. They'll get tired. Reverend, we are seeing that as well in our own workforce. We have employees that do turn into travel nurses because it's an opportunity for them to earn more money and have more of a flexible schedule.
Yeah, because I thought I had them locked in, you know.
So this brings me to the, good point, to my next point, is recruitment and talent attraction really requires a holistic approach. We want to attract people that are driven to our mission, right? That where we are able to share our JPS story to the community. It really is special to be here. And we have a lot of employees that tell us all the time the reason they're here is because of the community that they serve. And that is something that we have to be able to share with the community as well. And also our leadership team, our ability to share their stories and how they interact with their patients and their employees as well. And of course, making sure that we have a competitive pay band and that we provide a flexible type arrangement from a work-life perspective and opportunity for growth and development. And so just to preview, as far as the growth and development, we are launching a new program in January, a new leadership program format, and we're calling it Our True North. Our patients needs a true you. And so we want to focus on the population, the workforce that want to stay here, that believe in us, that believe in what we do. And so we're going to develop them to a point where they show up with their whole self. Excited to share that with you in the future. Switching gears to employee engagement. Sorry about that. Go ahead.
All right, no, just one of the things that we want to keep in mind also is we had that discussion the other day about benefits and what benefits could really do to pay and a competitive salary.
I agree.
Should a salary not be sufficient enough, some of the other kind of tangible benefits can really support somebody else coming through.
Right.
Well,
Makes sense.
I don't want to speak for you, Madam Chair, or for you, Madam Chair, but we did speak in budget. Trent spoke about even finding something way out of left field.
Yeah.
That to not be afraid to bring it to us. Don't let cost be a factor. Don't let whatever, but whatever creative ideas that there are out there that can help us recruit not just nurses, not just doctors, but for every position in the hospital. We should have the opportunity to evaluate those through this committee and then through the board, and not be afraid of it.
Yeah. And I
Free
appreciate
go-kart
that.
rides. I mean, whatever,
I really
just-
do. Right. No, and thank you so much. I have that written. Don't be afraid Yeah. We have.
She is not afraid. Usually Monday, she's like, oh, I need another 10 million. I'm like, oh, okay.
It is a competitive landscape, I have to say, but to your point, there are tangibles and intangible things that we need to be looking into, and that's our plan, is we're continuing to analyze our total rewards package. Thank you for that.
Are you looking at, go ahead.
I was just going to say, when you're talking about this holistic approach to recruitment, I think one of the things about healthcare in this state kind of post-COVID is there's an element of fear to it. Patients and patient families are increasingly aggressive, argumentative.
That's right.
And then just recently in the news, there's been nurses who have been killed, the medical examiner's office. It seems almost like an unsafe profession to be in. And that may be something in some of your advertisement, recruitment, is what things are being done at JPS to ensure the safety of the nursing staff.
That's a good point. Thank you for bringing that up. And yes, and if you look at our local market, us being, level 1 trauma center, we see more of that from a workplace violence perspective. And so the exposure is absolutely there. But thank you for sharing that. We need to also share how we are keeping our staff safe.
Are you recruiting just within the United States, or are you recruiting internationally also?
In the moment, we are focusing in the local area, and then if there are interests outside of the area, because people look at our website across the country, we socialize with those candidates as well. We're not doing any international recruitment at this moment.
I know a number of years ago, there were a lot of nurses that came over from England, and we're here because my wife was a nurse, and she wound up working with some of them.
Yeah, right.
Carla, you can share.
We are exploring that option now on how we can recruit internationally. There is a huge uptick in international recruitment, especially, a sixth of the nursing workforce really is internationally trained. We have spoken with a couple of staffing agencies, immigration lawyers, to explore what we can do in that space. So we're hoping to provide some solutions soon from that perspective to give us some long-term staffing needs.
To Dr. Holland's point, there is an unspoken anxiety, in the healthcare field right now, especially with recent events. And it's important for us to make sure that we pay attention to that. I think Baylor Scott & White just did some major enhancements on a really advanced technological weapon detection system, and they also made some advances in their technical safety and safety approach. So it would be important if we make sure we look at that, pay attention to it, and that we're doing everything we can. I know, Dr. Duncan, you made a great communication after that, and I know you had paid attention to that, so appreciate that. But it is important, and that would be a great selling point, right, in our system.
And Bill can speak up probably a little bit more to this, just how we are approaching this, both reality that we're seeing with a lot of aggressiveness from patients. Go ahead, Bill.
Thanks, Dr. Duncan. Yeah, in fact, Dr. Haynes, we ended up engaging a third party to come in and do a workplace violence assessment. There was a couple of, at Dr. Duncan's request, we had a couple of incidents, and so we just wanted to do an overall safety review of everything here, but also of all our external campuses. And then we came back, it's like a 22-page report, but one thing we already started is what you talked about, this enhanced camera certification. It has the ability to detect whenever a weapon is brandished. It's called Zero Eyes, and that capital's already gone through and been approved. We have a number of other initiatives, and surprisingly, one of the things we haven't been doing, but that they encouraged to do and was a best practice was communication and making sure that we are keeping everybody aware of incidents that do occur, because and then ways to stay safe, of course. But that communication was a pretty big point. So we'll have a good plan. We definitely have a roadmap of everything we need to do to enhance security from where it already is, and we'll be pursuing that for sure. Thank you.
Thank you. That's great. No, that's a great selling point and to be communicated. Thank you.
Okay. Switching gears to employee engagement, as I mentioned, we just finished our second year of employee engagement survey with Gallup, and that was administered between September 19th and October 4th. Let me just say how proud I am of JPS for the work and the effort that they put forth to promote and encourage participation. 88% overall participation rate is a huge increase from last year at 71%. We have a lot more employees participate, and I mean, look at this. Despite the odds, we're swimming upstream here in healthcare, right? We improved 10 of the 12 questions on the Gallup survey. One remained the same, and only one decreased by 0.02. So truly kudos to the whole team for being an anomaly in the healthcare industry and improving our employee engagement scores compared to others where they put goals that would decrease it year over year. So let me show you the breakdown of the questions. Let me orient you to the color scheme. Gallup changed their color scheme from just green, so from light green to dark green being at a higher percentile. As you can see there, you're seeing a lot more dark greens, and what this comparison is, it's against all hospitals in the Gallup system, and we're talking about 1.2 million respondents, 123 business units, and almost 100 clients. We compare against those hospitals, and how we end up is just incredible. We sit at the 75th or higher percentile across the board. Majority of the hospital systems are between the 34 and the 36th percentile. Year over year, JPS improved our engagement score from 51st to 52nd percentile. And so, again, kudos to the JPS team for promoting this survey and making sure that we have an engaged workforce. So how did we end up in terms of our AIP metric? Our goal this year at threshold was 4.09. Now, we ended at 4.08, and believe me, I demanded a recount 5 times.
She's denied it.
I believe that a 0.01 miss is insignificant, and so we consider this a huge win. If you can see the breakdown there from 21 to 22, 1,300 plus respondents, 17% increase in participation rate, and that 0.04 increase in the engagement. And so again, it's still a win for us, and we will use this to continue to improve our workforce engagement for the next year.
So Carla, just stay here for a second, because Carla mentioned this, but I do want you to hear that across all similar healthcare industries that Gallup polled, on average, they lost 8 points. On average, they lost 8 points, and we gained 4 points. Mm-hmm. So when we met with Gallup, they were totally kind of blown away by the fact that majority of healthcare places lost. And across all industry, there was a loss. But here at JPS, we were able to gain 4.
Yeah. The 12 questions, basically that's what that is, just 12 questions. The Gallup, through research, has indicated that those are the questions that determine the level of engagement of employees. They have other surveys. In this particular one, they refer to it as Q12. I'm sorry?
It's 13 items, but they call Q12.
The 13th one is an overall satisfaction, and it doesn't count towards the mean. Yeah.
Just trying to. Just want to make
It's kind of tricky. That's right, Baker. But that's what doesn't count. And so in analyzing our overall score, Gallup will tell you that there are 3 areas that would make the biggest impact on our overall score. And those are around recognition, care, and opinions. So we are going to be working very closely with our leadership team to develop action plans around their specific their departmental scores to ensure that we are continuing to engage our employees. And our primary message to the leaders are 2 things. It's consistency and communication. So consistency in messaging, making sure that you are saying the same thing with one group, with all the different groups, and just using communication 7 times, 7 ways to make sure that the points get across appropriately. Our partnership with Canaris is continuing to evolve. I'm happy to announce that we are now entering a new phase. We are going through an organizational system audit, and we just kicked this off last week. And what we are doing is we're going to analyze all of our policies and procedures from an end-to-end employee perspective to ensure that every single one is inclusive in nature. So this is going to take a few months to really assess every single policy that we have in place. So we have a team that will be focusing on different parts of this assessment, and we're hoping to have some updated ones in the spring. Okay. All right, at the end of the day, I just want to say that in HR, our primary focus is workforce transformation. And a lot of you did mention just different aspects of what it means to be a part of an organization. It's the total rewards package, it's the competitive nature, it's recruitment, it's leadership development, and it's that feeling of belonging. And so we came up with a new employee value proposition that resonated with a lot of the team members in HR and also some of the employees that we socialize this with. So our goal is to create a meaningful connection between employees who serve our workforce and the people we serve, our community. And we're going to create some type of campaign around this and create, again, some storytelling opportunities so that the community and our organization, that they're aware of what we are truly doing for our True North, our employees. And foundationally, as I mentioned, our True North needs a True You that will continue to be our anchor, and we will approach that in multiple facets, from recruitment to leadership development to diversity, making sure we can trust our data and that we have a very holistic approach to wellness and total rewards. Okay?
I'm familiar with DEI. When do we add B in there, and what does it really mean?
B is belonging.
But what does it really mean?
So essentially, if you combine diversity, equity, and inclusion, belonging is in the center, and it's truly the feeling of when you walk into the room, you know that you belong there and that you are welcomed.
Okay.
Okay. That is all I have. Any questions from the board?
I understand that.
Nobody's going to talk about it.
Just move on, just move on. Well, I want to hand it over to our COO once again, and he's going to go over our organizational goals.
Thank you.
Thank you.
That's good.
I've worked with Gallup for many, many years. It's very impressive type of drastic uptick that we're seeing. So thank you, and to your team for being able to continue that.
And thank you for your support. We really appreciate it.
You know, I think it's commendable to, when you look at back on the engagement meeting, that we increased that 0.04 based on the environment.
Yes, absolutely.
We're doing something, must be giving out candy canes.
What do we?
That was the turkey dog.
Questions was in regards to quality, and that was one of the scores that how does that correlate, and are we concerned about that? Because if the employees are saying we're not concerned about quality, that seems like a bigger issue than any quality issue that might pop up.
Yeah, I'm not sure how much, second on that one, Roger. We did see some of that on the physician engagement, and we'll come back at a later date to also speak about the perception of quality. And it's interesting you asked that, considering we do well with like Leapfrog and some of the other.
Right.
Again, this gets back to the communication, to the organization, down to the deep levels as to work that we are doing, and to speak about it as part of our culture. It probably needs to be added to one of our 3 rules, but you really do have to communicate that throughout the organization, and we've seen that there is opportunity for us to do that better. Speak about the quality that we do.
Yeah. All right, so next is our number 5, Consider Human Resources Matters, and Bill Masterson will talk to us about our FY 2022 Annual Incentive Performance Achievement Plan.
All right. Thank you, Madam Chair. I think I have a pretty easy job today because for those that were in the Quality Committee, Monday, you'll have seen the first 2 items. For those that were in the Finance and Board Committee meeting right before this, you'll have seen the 3rd item. And Carla just covered the... Oh, he doesn't have it. Sorry about that. It's on page 24 of your handouts. So the first one we covered Monday, Laura Burnside covered the patient experience, and that was on page 28 of our book. And you can see these are the results of our 2022 annual incentive plan, how we ended up the year. So we had a target of 73.4, we finished at 74.5, and a stretch goal of 73.9. So we outperformed even the stretch on patient experience, so that's a good story. On heart failure readmissions, this was also covered in the Quality Committee meeting. We actually underperformed our goal. Our target was to get down, and heart failure, on a readmission statistic, lower is better, not higher is better. So the target of 10.78, we ended up finishing around 11.4, and so we didn't even meet the threshold on that, which was 11.11. But I can tell you, significant progress was made. There was a significant amount of work done on this, and a lot of learning occurred for our organization. When we get to the 2023 goals next, I'll talk about what we are recommending to this committee to consider for next year, because that's a pretty narrow disease process for everything that JPS takes care of here. So we'll talk about that. We covered the supplier diversity spend, and Daphne indicated this morning it was 24%. I carried it out to another decimal place because, like DT, I have a finance background. So the target was 20%, so we significantly outperformed the target, but just a little less than stretch. But we did very well on that, and I think we covered that quite extensively this morning. Next, Carla just went through employee engagement, and Dr. Duncan emphasized the main point we wanted to get over is that most hospitals actually had a retraction in employee engagement, and we actually still improved over the prior year. So we're pretty happy with that, but we did still fall short. Even though we're better than last year, we did fall short of even the threshold. And then clinician engagement, we actually had underperformed even the prior year. And some of the issues that, some of the biggest issues, and we'll have a full presentation in the Quality Committee for this, but just for your awareness, overall it was the same kind of Q12 deal. It was overall satisfaction came down, was one of the most significant, and another question about JPS being the perfect hospital for me. Those are the 2 questions that underperformed the most compared to the prior year. So with that, we ended up, those are our 2022 results on our scorecard. We did have a positive operating margin, so that the circuit breaker or the trigger was accomplished. Next, I wanted to go over the 2023 goals, if that's okay. And that's on page 26, 26 right there, and I got it up on the screen now. If you'll notice, one column that's not shown here anymore is baseline, and what I am showing is threshold. And threshold, if you'll take those numbers, are equal to the previous year's results. And so that's what we're recommending, is that no sort of performance be measured against, if you can't improve over where you were last year, you shouldn't have any kind of performance improvement. So that's why we moved to that situation. And then as we went from threshold to target to stretch, we kept the same percentages as we had the prior year. So we used the same methodology to spread it among threshold, target, and stretch. So for patient experience next year, we finished the year at 74.5. Our target next year, 75. For 30-day readmissions, this is the big change from last year. So if you remember, last year we used 30-day readmissions for heart failure patients only, for JPS connection patients only. And so this year what we're recommending, because that's such a narrow part of the overall stuff the hospital works on, since we're really looking at this as a balanced scorecard and trying to give an overall perspective on all quality, we thought it would be better to use what like CMS uses, and that's all-cause readmission. But one enhancement we took here, because we don't have our Medicare population is not as big as the average hospital, we recommended using all payer, all cause. And so we use the same definitions that we report to CMS, so there'll be no definition questions or controversies or recalculations. It's a number we report, we can pull it right off a report, and that'll be our overall, now it is a proxy, but it'll be our overall indicator of how quality is doing at our hospital. So that's, we finished last year at 10.7, and we're recommending we use the same kind of improvement that we used last year for those percentages. 10.4 and 10.1. And that's over, and if you think about, while those may not seem like huge moves, when you think about the 16,000 admissions that we have, those are big moves. Supplier diversity spend, we're now targeting a threshold of 24%, 29% for a target, and 34% max. Employee engagement, our target's going to be 4.13, and for clinician engagement, 3.94, and we'll recommend keeping in place for the AIP plan the same AIP trigger, that without a break-even operating margin, no AIP be considered. That concludes my recommendations.
Any questions for Bill?
I do think the change was great. This is where we ended, that's where we start, and we'll move forward. And that has been a discussion for the last few years, so thank you for that. I'm thinking about that, all admissions. I think it's okay. It's a larger pool, so it's harder to control. Yeah, that's what I was thinking about. There's going to be a larger number.
Focus on those that drive the most readmission.
But I think they were good. Okay.
Do we have to get approval
Thank you.
of the 23?
Yes, sir.
23.
Yes.
Did he ask for approval?
Yes.
Okay. National average.
Okay.
What's the national average?
So I use the same, so I mean, I'm happy to.
I think CMS, the number is higher than this. They like,
right.
When you mix it up, it's like 11 or 12%.
Right, but that's what I was getting at earlier, is CMS is just Medicare only, and I'm saying all payer.
Okay.
So they put more pressure on themselves.
I know. I'm trying to give you a break.
No, I know. You need to be higher.
I think you're going into closed session with Dr. Duncan, so I think you can address that. But I followed the same methodology as last year, so it was formulaic.
This is specific to CHF, though, right?
No, this is all cause, all payer.
Oh, okay. Last year was CHF.
Last CHF and JPS connection only.
Yeah. Okay.
Yes. Thank you, Mr. Finance Chair.
We're going to do it after we come out of close.
Yes. We are going to close. We're going to close. All right, thank you, Bill. We'll now go into closed session, and we'll see y'all in just a second. And do I have a motion?
So you want me to go ahead and ask for approval?
Yes.
Okay.
They didn't have a clue.
We are in open session now.
Okay.
We're in open session now. Hold on.
It wasn't a formal motion, it was hypothetical.
There's no, Dr. Duncan.
So we are asking for approval of the FY 2023 AIP goals and also requesting approval of payout of our annual incentive payment based on the reported 10.5% achievement that was reported.
Move approval.
Also asking for approval of our long-term incentive payment based on the reported achievement.
Second. All right, I've got a motion and a second. All in favor, say aye. Aye. Any opposed? Motion passes. Thank y'all so much. Do I get a motion to conclude this HR committee meeting? I'm sure.
You
Thank
want to belong.
All right, that concludes our HR meeting today. Thank you so much.
Happy